we talk, and last time I was talking to you, Cameron, I was saying, well, you missed a little bit. We were above 4,000 in the S&P, and you stuck to your guns, said, I don't like it. I don't really feel that great about things. And next thing you know, we're testing 3,800 again, and we're up a little bit today, but it's been a tough couple of weeks. That's what a trading range looks like.
Exactly, and that's what a downtrend looks like, which is why at the beginning of October, we were nervous to be too negative because we were very oversold. But as we got close to that 200-day moving average, when we looked at where we were standing on EPS estimates, on valuations, really it was really hard to justify the market moving that much higher on anything other than short-term technicals. So we think that a retest of the October low is very much in play. It doesn't have to come before the end of the year. We could see trading be a little bit more firm just into the last 7 days of trading. But then as we look into the first quarter, we think that because of that downward pressure on valuations from higher interest rates, and because of the downward pressure on earnings because of lower growth, it really does support a market moving lower from here.
You could have lower absolute sales in a weaker economy, and if inflation is still persisting, you'd have a profit margin problem too. So you got higher interest rates, which bring lower valuations, and eventually you get slower sales growth and lower bottom line too from profit margins. I don't want you want to keep talking about this, Cameron. We're not saying one positive thing.
Well, I think the positive thing is what we're seeing this morning from Nike and FedEx, which is controlling what they can. You never want to bet against the great American might of profit margin expansion, and that's clearly what's happening with both of these companies. There's pressures in their business, whether it's Nike and having to destock inventories, or FedEx seeing a big drop in volumes for its more urgent business like Express, but they're taking costs out of the business, and that can help insulate margins some. But then when we look into 2023, we actually see falling inflation as a potential headwind to margins, simply because it would lower revenue growth, top-line revenue growth, which puts downward pressure on what we call incremental margins. And so what that could set up for is a peak in margins that we saw back in 2021, continued declines, and that's really the wild card as we think of where earnings could settle into next year.
I guess if Tesla's down 65, Meta's down 60, so many of the most beloved stocks and the biggest high flyers, as interest rates have gone up, we said this might happen, and it's now happened. Long term, couldn't you put together a shopping list for Christmas of like 30 incredibly great companies that are 60% less, valued at 60% less? Couldn't you do that? Should you? Are they a buy? Should you buy?
I think that it's a very good exercise, because oftentimes what we see as we roll into the new year is that the last shall be first, meaning those that got beat up the most in the past year can find a little bit better footing. Now, I don't want to make the argument that all growth, all tech stocks are at valuations that we would consider cheap, because if I look at the Russell 1000 Growth Index overall, it's still trading 30% higher on valuation, so about 25 times earnings, compared to the last time when real interest rates were at this level. So real interest rates are about positive 1.3%. So that would tell me that we haven't seen the full extent of multiple derating for the broad index, but there is likely some opportunity within names that have seen their multiples derated and, importantly, have seen their earnings estimates come down a lot, which means that you just have a low bar to be able to jump over into 2023.